Hi everybody, this is Eddie Ghabour, Managing Partner of Key Advisors Group, and in today's video I want to discuss a question that I've been getting a lot is how do you know when to buy the dip, or what are the factors you look at in determining whether a dip opportunity in the market is a buying opportunity or if it's the beginning of a bear market. We've been making a lot of calls this year that fortunately have been pretty accurate in regards to the timing of buying a dip and not having us consider it being the start of a bear market. I want to kind of talk about some of the things that we look at. And I want to make sure that I mention and really stress the fact that there's never just one factor that you look at. You have to look at multiple factors to come up with a decision. And also understanding this is a difficult game to play and you're not always going to be right. And it may take a few weeks for your trade to actually be correct. But the other thing too is you have to admit when you're wrong. And God knows I've made plenty of mistakes in my 20 plus years in managing assets, and you just try to learn from them. And so if you're buying the dip opportunity doesn't work out, you can't be so hard-headed and not admit you were wrong and get out of that trade, because sometimes that can cost you more money. So you really have to be open-minded and understand that there's times you're going to be wrong, there's times you're going to be right. But if you have a strict process and follow through with it, you can have some consistencies that allow you to risk manage your assets throughout turbulence markets. Because look, the bottom line is this: stock market and equity markets are volatile, and they're always going to be volatile in my opinion. That's something that has been that way since the start of the markets, and it's not going to change. And with the algorithmic trading that's in today, you can see even more movements and volatility. Especially this last dip, we got a lot of questions. There was a big firm that came out and said we were getting ready to have this 20% correction that we respectfully disagreed with. And it was because of the process we follow and looking at certain things. So one thing that we look at quite a bit is interest rates, right? There's a saying in our industry that the bond market is smarter than the stock market. I actually firmly believe that. So when you're seeing a big drawdown in stocks and the media is just telling you how the end of the world is coming, one thing we'll take a look at when we're seeing this is, again, trying to ignore the noise that's on the media, because they're nothing more than Monday morning quarterbacks most of the time, is look and see what the fundamentals are telling us. And so we take a look at the bond market, and these last few dips that we have bought or recommended buying for the right investor, the bond market was telling a completely different story than the stock market. You were seeing the stock market sell off and the bond market was pretty calm, and if the bond market was showing a lot of disruption in conjunction with the stock market tanking, that would be a red flag for us. Again, we're not just going to let the bond market determine our decision-making process, but it is one of the most important parts of trying to looking at fundamentals. So we take a look at the 10-year bond and really kind of see how it's reacting. 10-year bond many times will be forward-looking in regards to growth, okay? The other thing we take a look at is what we refer to as high-yield spreads, right? What is the difference in yield between the risk-free rate versus the higher risk rate? And if there's not a huge wide spread or the spread's not really widening, that is another signal that the bond market is telling us that, hey, the stock market is more than likely overreacting, and this could potentially be a great buying opportunity, not a selling opportunity. This latest dip that we had that kind of spooked people, the high yield spreads were barely moving. The 10-year bond was very calm, and so it kind of reinforced our thoughts on the fact that, hey, this is nothing more than another opportunity. Again, you have to be the right investor with the right risk tolerance. But again, the bond market was signaling, hey, risk on trade is still okay based on what the yields we're looking at. The other thing we look at is the VIX, okay? The VIX is the volatility index. And in our opinion, the VIX doesn't really start getting our attention until it goes over 30 and stays there for a few days, okay? And we've had these huge spikes in VIX all throughout this year. And if you look at the last 20 plus years, you see these big spikes in the VIX. And again, just using this last dip as an example, because it was the most recent one we've had, but you can apply these metrics to any dip, really, to try to educate yourself. So during this last dip, we had a big spike in the VIX, but it couldn't get over 30. And if it did, it was there for just an hour or so and back down. It didn't even stay there for a full day, let alone 3 or 4 days. So you had the bond market telling us things were okay. The VIX was telling us it didn't want to get into that scary territory for us where it's over 30. So that was another check that we would check off in regards to the fact that it was a dip buying opportunity. The other thing we take a look at is what we refer to as positioning, okay, and how a lot of money is positioned in the market. And for you, you could even listen to the rhetoric that is on Twitter or on the news and on the headlines. A lot of times when everyone is screaming that the market is going to bear market territory and everyone is positioned for a crash, very rarely will you see that consensus right. Okay, so again, in this last dip that we saw, the bond market was telling us something different. The VIX was telling us something different. Couple that with the fact that the positioning where everyone was positioned, or I should say a lot of dollars were positioned, they were positioned for a bear market. Many institutions were short the S&P 500. You saw a lot of positioning going into defensive names and out of the cyclical names. And then everyone in the media was saying, here we go, here's the start of this 20% correction that we've been waiting for. Understand, markets don't correct because we haven't had one in a while. They're going to correct when the fundamentals say that it needs to correct. And a lot of times we need to see GDP decelerating. We need to see the consumer spending numbers really come in. We need to see the VIX high. We need to see the bond market really break down. And again, the VIX was telling us something different. The bond market was telling us something different. And in regards to positioning, everyone was just so bearish. That was another, again, check of the box that tells us, hey, maybe we need to be buying this dip instead of selling it like consensus is. The other thing that we looked at, and I said this in one of my national TV interviews during that week, was we looked at gold, okay? Because gold many times is a safe haven, okay? So when things are really, really scary out there, a lot of times you'll see money flows go to gold and you'll actually see that commodity actually go up in price. Gold really wasn't doing anything, okay? So that was the fourth sign or fourth signal, if you want to call it, in regards to the fact that this big sell-off that we were supposedly going to put us into this 20% drop, again, was signaling that maybe this was a buy the dip opportunity. So when you're looking at these assets in conjunction with the bond market, the volatility index, and where everybody is positioned, this was one of the rare instances where all four of those signals were telling us that it was a risk-on environment, in our opinion. Now, could there have been a time when we were wrong? Absolutely. And look, we may still be wrong. We don't know. But here in the short term, buying the dip has really worked out. Now, there will be a time when those signals that I just talked about start to tell us a different story. And more than likely, when those things start telling us a different story, the market will be at a very high level and consensus will be very, very bullish. You know, call me a contrarian by nature, but going against the herd in the investment world has been very, very profitable many, many times. Because again, when you have so many people on one side of a trade, many times it'll go in the other direction. But if you look at some of those indicators, and there's a lot more than what I just shared with you, but just those four indicators many times can really give you a head start or maybe even a little edge in regards to when to start slowly de-risking, okay? Because again, we do expect to see that in a secular bull market where you'll see time periods where the market could have 15 to 20% corrections. And when it looks like that's going to be a sustainable thing that will happen, we're going to do the best we can as risk managers to use those four signals to kind of allow us to get ahead of it before it actually happens, okay? So understanding the signals in regards it tells you when to buy the dip is also the same signals you look at as when it says, hey, don't buy the dip and maybe start lowering risk in your overall portfolio, okay? So do yourself a favor. I'm a big believer in educating yourself. I try to educate myself every single day. I try to get better at what I do by surrounding myself with really smart people, reading a lot of research, and trying to find any competitive edge I can for my clients, for myself, my family, and everyone that we try to educate on these videos. So that's our tip for today in regards to looking at those signals that I just shared with you that can many times give you a head start and let you know what direction the markets are heading. So that way you don't have to depend on the media to scare you into selling or motivate you into buying. Because again, by the time they get that news out to you, those signals have already broken down one way or another. Okay, so that's it for today. Please send me any questions that you have, and I hope you found this to be a very valuable part to your investment process.